It is Sunday, April 12th, 2026, and I need you to look at a number, $75.76. That is the bid price at which silver closed on Friday, April 10th at 5 o'clock Eastern Time. That number is sitting on every financial terminal on the planet right now, unchanged, frozen. And I am going to explain to you why that number is one of the most dangerous pieces of information in the global financial system at this exact moment. Not because it is wrong in the way you might think, but because of what it assumed when it was printed. That $75.76 close was the market's verdict on a world where 21 hours of direct diplomatic talks between the United States and Iran were still considered to have a meaningful chance of success. It was the closing price of a week in which the NASDAQ 100 surged more than 5% on the premise that the most significant diplomatic opening between Washington and Tehran in nearly half a century was working. It reflected equity markets, bond markets, and precious metals. Markets all simultaneously positioned for a world where tensions in the Middle East were moving toward resolution. That world stopped existing sometime this weekend. And the moment CME Globex opens at 6 o'clock Eastern Time tonight, the price on your screen is going to be forced to negotiate with a reality that it has not yet accounted for. The last number you saw was the price of optimism. What comes next is the price of failure, and those two prices are not the same. I have spent years tracking this market through supply shocks, geopolitical escalations, physical delivery crises, and paper market dislocations. I have watched silver move from below $30 to over $110 at its January 2026 peak. I have watched it shed 37% in 3 weeks during the acute phase of the Iran crisis, then rebuild as the structural forces underneath it reasserted themselves. I know what this setup looks like. I know what it sounds like before it moves. And I am telling you right now, on this Sunday afternoon, that the variables aligning around tonight's futures open are not ordinary. This is not a situation where the market drifts a few cents in either direction while algorithms sort themselves out. The entire thesis that has governed positioning across equities, commodities, and precious metals this week has been invalidated over a weekend when no Western exchange was open to absorb the shock. That is a specific kind of pressure. And when it releases, it does not release gently. Let me give you the exact sequence of what happened this weekend, because the details matter and the mainstream financial media will not lay this out for you with the clarity that you need before the opening bell. 21 hours. That is how long negotiators sat across from each other in Islamabad in what had been described as the most consequential diplomatic encounter between the United States and Iran since the Islamic Revolution of 1979. 47 years of no formal diplomatic contact between these two governments, and this week the market decided that barrier was finally breaking. The NASDAQ ran more than 5% higher on that belief. Institutional funds rotated out of defensive positions and into risk assets. Ceasefire optimism became the dominant market narrative across every asset class. The talks produced nothing. The vice president made the administration's conclusion clear without any diplomatic softening. Iran chose not to accept the terms placed on the table by the United States. Iranian state media, specifically Fars News, confirmed independently that Tehran has no intention of resuming negotiations with Washington in the foreseeable future. The door that cracked open for the first time in nearly 5 decades has been shut again. And given the extraordinary complexity of the diplomatic scaffolding required just to get both parties in the same room, intermediaries and Oman back-channel communications built over months, the door does not reopen quickly. The specific breakdown point was Iran's refusal to provide any commitment against the development of nuclear weapons. That was the American non-negotiable demand. It was not a secondary condition. It was the central one, and Iran would not move on it. Every analyst who spent this week building positions around the thesis that a deal was structurally achievable was wrong. Every fund that bought the relief rally with leverage is now holding a position built on a foundation that no longer exists. The timing compounds the problem. The ceasefire itself had been a tentative 2-week arrangement brokered through Omani intermediaries. It was always fragile, and its fragility was always the risk that the market chose to look past during the week's rally. That choice is now a liability. The question that every institutional desk is asking tonight is not whether this repricing happens. It is how fast and how far. And here is the answer to both questions. Faster and farther than the current paper price in silver reflects. Because the paper price was printed 48 hours ago in a world that no longer exists by a market that has been closed ever since. I want you to understand something that you will not hear from Bloomberg or CNBC until they are sitting in front of their cameras Monday morning explaining something they failed to warn you about. Bitcoin is already selling off. That matters more than it might appear. Across 2026, cryptocurrency has repeatedly demonstrated its role as one of the earliest and most reliable barometers of shifting risk sentiment among global institutional investors. When the news of the collapsed talks began circulating, Bitcoin did not hold. It did not behave like a safe haven. It sold. The risk-off impulse is already moving through digital asset markets in real-time hours before the silver futures market even opens, hours before Western equity traders have returned to their desks. That selling is the leading edge of a much larger wave. Shanghai is coming online tonight. Tokyo is coming online. Singapore is coming online. These markets have been awake all weekend. Every significant institutional player in Asia, sovereign wealth funds, family offices, commodity trading houses, central bank reserve managers, has had 48 uninterrupted hours to absorb the full implications of a US-Iran diplomatic collapse in a financial environment where their trading terminals never went dark. They have not been idle. And the physical silver market that they trade is fundamentally different from the paper futures market that set Friday's closing print. Because earlier this year, in January 2026, the Chinese government reclassified silver as a strategic dual-use material and imposed state controls on exports. That single policy decision removed one of the largest sources of physical silver supply to Western markets. It was not reversed during the ceasefire. It was not softened during the week's relief rally. Every institution in Asia that buys silver for industrial use for monetary reserve purposes or as a geopolitical hedge has had to source that metal from a constrained global pool, paying physical premiums of 50 to 80%, above the official spot price at the most acute points of the January crisis. Those structural constraints have not disappeared. They have simply been temporarily overshadowed by the narrative of diplomatic progress. Tonight, the narrative is gone. The structural reality remains. And the Eastern institutions that have been accumulating physical metal throughout this entire period are not looking at $75.76 as a ceiling. They are looking at it as a mispricing that a closed Western market created and that they are about to correct. This is where I need you to make a distinction that the financial media routinely collapses, and that collapsing it has cost investors enormously over the past 18 months. The official silver price, $75.76, bid $76.01, ask, as verified from Kitco moments before I recorded this, is the price of a futures contract. It is the price of a promise. It is the price at which a paper claim on silver changed hands on a regulated exchange in an environment where that exchange's settlement mechanisms, its delivery infrastructure, and its institutional counterparties were all operating normally. The physical silver market does not always trade at that price. It has not traded consistently at that price for much of 2026. During the January peak of the Iran crisis, when Chinese export controls were freshly imposed, and institutional demand was surging against a suddenly constrained supply base, physical silver was trading at premiums of 50 to 80% above the official spot price in certain markets. Dealers were sold out. Sovereign mints were posting 12-week backlogs. The online retailers that typically serve retail investors were displaying sold-out notices across entire product categories. The gap between what the screen said and what you actually had to pay to take possession of silver was the largest such dislocation in modern market history. That gap narrowed during the ceasefire period, not because the structural supply deficit was resolved, it was not, but because investment demand temporarily softened as capital rotated back into equities on the premise of diplomatic progress. The physical premium compressed, the paper price recovered, and the illusion of normalcy returned to the market surface. But underneath that surface, the structural reality never changed. China's export restrictions are still in force. The global supply deficit, the gap between what industrial and investment demand requires and what mining, refining, and available inventory can deliver, is still intact. The pool of immediately deliverable physical silver in Western vaults is still at historically constrained levels. What the ceasefire optimism bought was temporary relief from the gap between paper and physical. Tonight, the optimism is gone. The gap is about to reassert itself. And when it does, the $75.76 print is going to face the same kind of negotiation with physical reality that it faced in January, the negotiation that took silver to over $110 at its peak. Let me walk you through the exact mechanical sequence of what is about to happen when CME Globex opens at 6 o'clock Eastern Time tonight, because this is not a situation where the market quietly adjusts to new information. The size of the mispricing relative to the current geopolitical reality and the concentration of positions built on ceasefire optimism creates a specific kind of pressure event. Let me show you why. Every fund that bought the Nasdaq's 5% plus rally this week bought it on a thesis. The thesis was, diplomatic progress continues, oil prices stabilize, the Federal Reserve's inflation calculus improves, and growth assets outperform hard assets. Every single component of that thesis was invalidated over this weekend. The positions built on that thesis are now wrong. Large wrong positions in institutional markets do not get quietly unwound. They get liquidated under pressure, and the selling that accompanies that liquidation does not stay contained to the asset class where the original bet was made. Consider the equity market structure. The top 10 stocks in the S&P 500 currently represent approximately 37% of the entire index. Even after declining 5 percentage points from their peak, they remain 10 percentage points above the concentration level at the height of the dot-com bubble. 6 of the so-called Magnificent Seven are already in correction territory. 2 of those, Meta Platforms and Microsoft, are effectively in bear market conditions. This is the concentrated architecture through which a geopolitical shock has to move tonight. When these mega-cap names face selling pressure, the cascade does not stay local. It spreads. And when equities cascade in a rising oil environment, the margin calls that follow create forced selling across asset classes, including commodities, including silver, and oil is not going to be quiet tonight. Analysts had previously calculated that any disruption to Iranian crude exports, which range between 1.6 and 3.3 million barrels per day depending on enforcement of sanctions, would add between $8 and $12 per barrel to prices immediately upon the risk being repriced. Before the ceasefire, Brent crude was approaching $130 per barrel. The diplomatic process had brought that pressure down. The diplomatic process no longer exists. Every one of those war premium dollars that leaked out of crude during the relief rally is now a candidate for reinstatement. Oil spikes, inflation expectations rise, and the Federal Reserve is forced back into a hawkish posture. Real yields move higher. Non-interest-bearing assets, silver, gold, face initial mechanical pressure from that sequence. This is the first phase of tonight's move, and I want you to understand it clearly so you are not blindsided by it. What happens after that phase is why tonight's setup is so significant, and I will get there. Before I show you the medium-term trajectory, I need to be direct with you about something that most channels get wrong, because being right about it is inconvenient for the narrative they want to sell. Silver's initial reaction to geopolitical shocks of this magnitude is frequently negative. During the Iran crisis earlier in 2026, silver shed 37% in 3 weeks. 37%, the same metal that had rallied from below $30 to over $110 at its January peak. The combination of a surging dollar spiking oil prices, driving hawkish Fed repricing, and forced liquidation across the commodities complex overwhelmed the safe haven bid in the short run. Investors who expected silver to behave like gold during that episode were surprised, and in many cases, hurt. Understanding why that happened is essential to understanding what comes next. Silver is not gold. It is not a pure monetary metal insulated from industrial cycles and macro dynamics. It sits at the intersection of monetary demand and industrial demand, and when those two forces pull in opposite directions simultaneously, when oil spikes create inflation fears that force central bank tightening while simultaneously threatening industrial demand, silver gets caught in a crossfire. That crossfire was the mechanism behind the 37% decline. But here is what also happened. Every single time across 2026 that the geopolitical risk premium rebuilt, every time Venezuela, Greenland, Iran, the Federal Reserve credibility probe, the tariff confrontations, or the monetary fragmentation narrative reasserted itself, capital flooded back into silver faster than it had left. And in the opening weeks of 2026, the dollar and silver rose simultaneously, which is not something that happens in normal market cycles. That anomaly occurs when investors are not hedging against a single isolated risk, but against the structural integrity of the financial architecture itself. The failure in Islamabad is precisely that kind of signal. This is not a localized geopolitical incident. It is confirmation that the diplomatic framework underwriting the post-1945 global order cannot bridge the divide that has opened between the Western financial system and the nations aligning themselves outside of it. When that confirmation lands in the market, the capital that temporarily rotated into equities on ceasefire optimism has to go somewhere. Some of it will chase the dollar's initial safe haven premium. But silver, which has already demonstrated that it can hold above $70 even through a 37% correction, has the structural support to recover and rebuild faster than most investors currently expect. The initial move tonight may be downward. What comes after is the trade that matters. I want to walk through why the standard institutional mechanisms for managing geopolitical volatility in commodity markets are less effective tonight than they would be in a normal shock event. The Federal Reserve is operating inside a constraint set that has no clean solution. Consumer sentiment has already fallen to 47.6 with one-year inflation expectations, climbing to 4.8%. Data confirmed in the Friday session. Those numbers reflect a consumer base that is already absorbing the stress of elevated energy costs from the Strait closure, supply chain disruption from the ceasefire period, and persistent uncertainty about the direction of trade and monetary policy. A renewed oil price spike flowing from the complete collapse of the diplomatic process adds fresh pressure to an inflation picture that the Fed cannot simply tolerate without losing credibility. But the growth side of the Fed's mandate is equally constrained. If 6 of the Magnificent 7 are already in correction or bear market territory before tonight's shock is even priced in, the equity market is not in a position to absorb aggressive tightening without material damage to household wealth, corporate investment, and credit conditions. The Fed has no clean move. Every option creates a different kind of pain, and markets know it, and today is Sunday. That fact is not incidental. This administration has established a well-documented pattern of using Sunday as the platform for major policy announcements, via social media, via press conferences, via carefully constructed statements timed to reach markets before Asian trading volumes build. The range of possible responses from the White House tonight extends from a renewed push for diplomacy through alternative channels, perhaps bypassing the Omani framework for something more direct, to a significant intensification of pressure on Iranian infrastructure or a more aggressive posture inside the Strait of Hormuz itself. Each of those paths produces a different trajectory for silver. A diplomatic pivot, even through alternative architecture, would probably weaken the safe haven bid in the short run and allow the risk on trade to partially reassert itself. A military escalation would spike oil immediately, initially strengthen the dollar pressure silver downward in the first hour. And then, as the inflationary consequences compound, and the monetary safe haven demand builds, create the conditions for silver's next leg higher. Both paths lead somewhere significantly different from $75.76 within the next 72 hours. The question is, which path is taken and how fast the market prices it? I want to give you the sequence of the next 3 days in concrete terms because this is not a single night event. It is a cascade that unfolds across multiple market sessions, across multiple time zones and understanding. The sequence is the difference between reacting intelligently and reacting in panic. Tonight, 6 o'clock Eastern Time, the CME Globex opens, and the first price action in silver since Friday's close at $75.76 is printed. The direction of the opening gap is the first data point, and it will tell you whether the market is treating silver primarily as a safe haven asset or primarily as a risk commodity subject to liquidation pressure alongside equities. Watch not just the direction, but the volume. A large move with high volume has conviction behind it. A large move on thin Sunday night liquidity is more susceptible to reversal when institutional desks come online. Between 6 o'clock and midnight Eastern Time, the Asian session builds its full picture. The physical premium dynamics in Singapore, Hong Kong, and Shanghai, markets that have been live all weekend and have had 48 hours to absorb the geopolitical implications, will either confirm or challenge the futures market's initial rid. Monday at 3 o'clock Eastern Time, European markets open. The London Bullion Market Association faces a decision that it cannot avoid. Price silver in alignment with whatever the Asian session has established or attempt to defend a level that the physical market may no longer support. Given China's export restrictions and the structural supply constraint, they have created any attempt to hold the LBMA price materially below the Asian physical market creates an arbitrage that sophisticated traders will exploit immediately and relentlessly. Monday at 9:30. Eastern, the New York Stock Exchange opens. By this point, the equity market is absorbing the full weight of unwinding ceasefire optimism, the impact of oil's reversal on inflation expectations, and the cascading effects of institutional margin calls. The concentration of losses in mega-cap technology names, where the ceasefire thesis was most aggressively expressed, means the selling pressure will not be diffuse. It will be concentrated, visible, and will drive secondary effects across the commodities complex, including silver. And underneath all of this, running on a longer timeline but with enormous structural weight, is the August 2026 deadline for the BRICS trade settlement launch. The silver price tonight is not just a commodities story. It is a signal about something much larger, and I want to be direct with you about what that signal is saying. The BRICS trade settlement system is scheduled to launch in August 2026. This is a framework that allows participating nations, currently including Brazil, Russia, India, China, South Africa, and over 30 additional countries that have applied for membership, to settle commodity transactions in a currency structure that is partially anchored to gold weight rather than to the US dollar. Oil, wheat, copper, lithium, rare earth metals, all of it potentially priced outside of the dollar's reserve currency monopoly. That is the medium-term context in which tonight's geopolitical shock is occurring. The Chinese central bank has been liquidating U.S. Treasury holdings for 14 consecutive months, converting more than $200 billion of American government debt into hard assets. Gold, silver, copper, and strategic materials. Since January 2025, that process did not pause during the ceasefire. It did not reverse during the relief rally. It continued systematically as institutional preparation for a world in which dollar-denominated instruments play a smaller role in global reserve allocation. The collapse of U.S.-Iran talks this weekend confirms something that the BRICS-aligned nations have been pricing into their behavior for over a year. American diplomatic reach into the regions that anchor the global energy system is constrained. If the United States cannot achieve a nuclear agreement with Iran after 21 hours of direct talks, the first such talks in nearly 5 decades, the projection of American financial and diplomatic power into the commodity-rich regions of the Middle East and Central Asia has a credibility problem. A credibility problem for American diplomatic power is a credibility problem for the dollar's role as the instrument of global order. And the market is beginning to incorporate that reality not through a single dramatic collapse, but through a persistent structural repricing that is now accelerating on this Sunday afternoon. Silver, which runs from below $30 to over $110 when this repricing accelerates, has already demonstrated what that structural shift looks like in price action. The ceasefire gave the market an excuse to pause. The excuse has been removed. Let me address directly the asset class that a significant portion of the retail audience for this channel has been told is the 21st century equivalent of silver or gold. Bitcoin is already declining on the news of failed talks sharply. In real time, right now, before a single silver futures contract has printed its opening price tonight, this is the test. This is the exact stress event that advocates of cryptocurrency as a safe haven asset have cited as the scenario in which digital assets prove their value. Acute geopolitical shock, diplomatic failure, rising risk of military escalation, potential energy crisis, everything that is supposed to drive capital into a store of value that exists outside the traditional financial system. And Bitcoin is selling off. It is selling off because it trades like a high beta technology stock. When the Nasdaq falls, it falls faster. When institutional investors need to raise cash to meet margin requirements during a risk-off event, they liquidate the most volatile, most liquid assets first. Bitcoin is both. The narrative about digital scarcity and decentralized networks does not change that mechanical reality. The market is speaking, and what it is saying is that cryptocurrency in a genuine crisis is risk, not refuge. Silver, in contrast, has maintained levels above $70 through one of the most volatile stretches in modern commodity history. It shed 37% during the initial shock of the Iran crisis and then rebuilt. It absorbed the 37% correction without collapsing its structural support, because the underlying fundamentals, the supply deficit, the export restrictions, the industrial demand from the energy transition, the monetary demand from reserve managers, those fundamentals do not disappear when a futures price falls. They create a floor that reasserts itself once the initial liquidation pressure clears. Silver exists in the physical world. It has weight. It has industrial utility across solar panels, electronics, medical applications, and critical defense systems. It has a millennia-long history as a monetary asset recognized across every civilization that has ever stored wealth. And it sits tonight at $75.76, priced on a thesis that collapsed over this weekend, waiting for a market that has been closed for 48 hours to tell it the truth. That market opens in hours, and when it does, the difference between physical silver and a digital entry on a blockchain will become very clear very quickly. I want to give you 4 specific signals to monitor as tonight's session unfolds, because these signals will tell you more about where silver is heading over the next 72 hours than any price target published by any investment bank. First, the dollar index. Watch the DXY in the opening 30 minutes of the Globex session. A sharp dollar rally confirms the initial safe haven demand for dollars, which typically creates headwinds for silver in the short run. A muted dollar response, or a dollar that declines despite the geopolitical shock reflecting market concern about American fiscal trajectory or foreign policy credibility, removes that headwind and allows silver's own safe haven bid to build without the mechanical drag. Second, crude oil. Watch the front-month Brent contract. The Strait of Hormuz carries 20% of global oil and 15% of all liquefied natural gas. Before the ceasefire, Brent was approaching $130 per barrel. Analysts pegged the Iran export disruption premium at $8 to $12 per barrel. Oil's direction tonight is the single clearest proxy for how aggressively the market is reinstating the geopolitical risk premium that ceasefire optimism had temporarily suppressed. Third, equity futures. Watch specifically the Nasdaq 100 futures and how the magnitude of the opening decline compares to the 5% plus gain that was built in on ceasefire optimism. If the market attempts to give back the entire rally on the open, the margin call cascade becomes the dominant mechanical story, and commodities, including silver, will face additional selling pressure in that first phase. Fourth, and most decisively, watch whether silver's opening move is sustained or reversed within the first 30 minutes of volume. A move in either direction that is confirmed by volume and holds across the first 2 hours of Asian trading has conviction behind it. A move that is quickly faded signals that positioning was more balanced than expected, and that the initial reaction was noise rather than signal. Silver closed this Friday, April 10th, at $75.76 bid and $76.01 ask. Its Friday range was $74.72 on the low and $76.96 on the high. It was moving in the right direction at the close of the week's last session. The structural case for silver, the supply deficit that China's export restrictions created, the physical premium dynamics that have characterized the 2026 market, the BRICS monetary transition timeline, the Federal Reserve's policy constraint, none of that has changed. What has changed is the ceasefire optimism that was temporarily suppressing those factors. That optimism is gone. Tonight, the market prices what remains. And what remains is the same structural reality that drove silver from below $30 to over $110. Today is Sunday, April 12th, 2026. In a matter of hours, the first post-weekend silver price will print. It will be the most consequential opening print for this market since the January crisis. And whether it gaps higher or gaps lower, what matters is not the initial direction. It is the structural story underneath it, which I have laid out for you completely in this video. The ceasefire thesis is dead. The supply constraint is alive. The geopolitical premium is being reinstated. The BRICS monetary timeline is unchanged. The dollar's reserve status is under structural pressure. Every single variable that drove silver's extraordinary run earlier this year is back on the table simultaneously. And the market is pricing them from a starting point of $75.76 on a Sunday afternoon with no Western traders at their desks. I have been tracking these setups for years. I will be watching tonight's open with full attention. If you want to be part of that conversation as it unfolds in real time, if you want analysis that does not wait until Monday morning to tell you what already happened, subscribe to this channel right now and ring the bell notification so you are notified the moment new content goes live. And drop a comment below before you close this video. Are you holding physical silver into tonight's open? Are you watching from the sidelines to see which way the gap resolves before making a move? Let me know where you stand. Because the people watching this channel are the people who understand the difference between what the screen says and what reality says. The market is about to make that difference very visible. The clock is running,